we shall study in detail the various accounting concepts on which accounting is based. The following are the widely accepted accounting concepts. First one, business entity concept. Entity concept states that business enterprise is a separate identity apart from its owner. Accountants should treat a business as distinct from its owner. Business transactions are recorded in the business books of accounts and owner's transaction in his personal books of accounts. The practice of distinguishing the affairs of the business from the personal affairs of the owners originated only in the early days of the double entry bookkeeping. This concept helps in keeping business affairs free from the influence of the personal affairs of the owner. This basic concept is applied to all the organization, whether sole proprietorship or partnership or corporate entities. Entity concept means that the enterprise is liable to the owner for capital investment made by the owner. Since the owner invested capital, which is also called risk capital, he has claim on the profit of the enterprise. A portion of profit which is apportioned to the owner and is immediately payable becomes current liability in the case of corporate entities. Money measurement concept. As per this concept, only those transactions which can be measured in terms of money are recorded. Since money is a medium of exchange and the standard of economic value, this concept requires that those transactions alone that are capable of being measured in terms of money be only to be recorded in the books of accounts. Transactions, even if they affect the results of the business materially, are not recorded if they are not convertible in monetary terms. Transactions and events that cannot be expressed in terms of money are not recorded in the business books. For example, if a business has 5 computers, 2 tables, and 3 chairs, the assets cannot be added to give useful information unless they are expressed in monetary terms, rupees 1 lakh for computers, rupees 10,000 for tables, and rupees 1,500 for chairs. This concept ignores that money is an inelastic yardstick for measurement as it is based on the implicit assumption that purchasing power of the money is not of sufficient importance as to require adjustment. Also, many material transactions and events are not recorded in the books of accounts just because it cannot be measured in monetary terms. Therefore, it is recognized by all the accountants that this concept has its own limitations and inadequacies. Yet it is used for accounting purpose because it is not possible to adopt a better measurement scale. Cost concept. By this concept, the value of an asset is to be determined on the basis of historical cost, that is, acquisition cost. Although there are various measurement bases, accountants traditionally prefer this concept in the interest of the objectivity. When a machine is acquired by paying rupees 5 lakhs, following cost concept, the value of the machine is taken as rupees 5 lakhs. It is highly objective and free from all bias. Other measurement bases are not so objective. Current cost of an asset is not easily determinable. If the asset is purchased on 1st January 1995 and such model is not available in the market, it becomes difficult to determine which model is the appropriate equivalent to the existing one. Similarly, unless the machine is actually sold, realizable value will give only a hypothetical figure. Lastly, present value base is highly subjective because to know the value of the asset, one has to chase the uncertain future. Dual aspect concept. This concept is the core of double entry bookkeeping. Every transaction or event has two aspects. First one, increase in capital and increase in asset. That is, for example, we can say commenced business with cash of rupees 1 lakh. Next, decrease in liability and decrease in asset. For example, paid creditors. Next, decrease in one asset and increase in another asset. Bought furniture costing rupees 5000 by paying cash. Next, decrease in one liability and increase in another liability. For example, we can say accepted a bill drawn by creditors for rupees 10,000. This is the concept which recognizes the fact that for every debit there is a corresponding and equal credit. This is the basis of the entire system of double entry bookkeeping. From this concept arises the basic accounting equation, that is capital plus liabilities is equal to assets. Periodicity concept. This is also called concept of definite accounting period. As per going concern concept, an indefinite life of the entity is assumed. For a business entity, it causes inconvenience to measure performance achieved by the entity in the ordinary course of business. If a textile mill lasts for 100 years, it is not desirable to measure its performance as well as financial position only at the end of its life. So, a small but workable fraction of time is chosen out of infinite life cycle of the business entity for measuring performance and looking at the financial position. Generally, 1 year period is taken up for performance measurement and appraisal of financial position. However, it may also be 6 months or 9 months or 15 months. According to this concept, accounts should be prepared after every period and not at the end of the life of the entity. Usually, this period is one calendar year. In India, we follow from 1st April of a year to 31st March of the immediately following year. Thus, for performance appraisal, it is not necessary to look into the revenue and expenses of an unduly long time frame. This concept makes the accounting system workable and the term accrual meaningful. If one thinks of indefinite time frame, nothing will accrue. There cannot be unpaid expenses and non-receipt of revenue. Accrued expenses or accrued revenue is only with reference to a finite time frame, which is called accounting period. Thus, periodicity concept facilitates in comparing of financial statements of different periods, uniform and consistent accounting treatment for ascertaining the profit and assets of the business, matching periodic revenues with expenses for getting correct results of the business operations. Matching concept. In this concept, all expenses matched with the revenue of that period should only be taken into consideration. In the financial statements of the organization, if any revenue is recognized, then expenses related to earn that revenue should also be recognized. This concept is based on accrual concept as it considers the occurrence of expenses and income and do not concentrate on actual inflow or outflow of cash. This leads to adjustment of certain items like prepaid and outstanding expenses, unearned or accrued incomes. It is not necessary that every expense identify every income. Some expenses are directly related to the revenue and some are time bound. For example, selling expenses are directly related to sales, but rent, salaries, etc. are recorded on accrual basis for a particular accounting period. Accrual concept. Under accrual concept, the effects of transactions and other events are recognized on mercantile basis, that is when they are occur and they are recorded in the accounting records and reported in the financial statements of the periods to which they relate. Financial statements prepared on the accrual basis inform users not only of past events involving the payment and receipt of cash but also of obligations to pay cash in the future and of resources that represent cash to be received in the future. Convention of materiality. Materiality principle permits other concepts to be ignored if the effect is not considered material. This principle is an exemption of full disclosure principle. According to materiality principle, all the items having significant economic effect on the business of the enterprise should be disclosed in the financial statements, and any insignificant item which will only increase the work of the accountant but will not be relevant to the users need should not be disclosed in the financial statements. The term materiality is a subjective term. It is on the judgment, common sense, and discretion of the accountant that which item is material and which is not. For example, stationery purchased by the organization, though not used fully in the accounting year, purchased still shown as an expense of that year because of the materiality concept. Similarly, depreciation on small items like books, calculators, etc., is taken as 100% in the year of purchase, though used by the entity for more than a year. This is because the amount of books or calculator is very small to be shown in the balance sheet, though it is asset of the company. The materiality depends not only upon the amount of an item but also upon the size of the business, nature and level of information, level of the person making the decision, etc. Moreover, an item material to one person may be immaterial to another person. What is important is that omission of any information should not impair the decision making of various users. Conservatism. Conservatism states that the accountant should not anticipate income and should provide for all possible losses. When there are many alternative values of an asset, an accountant should choose a method which leads to the lesser value. Later on, we shall see that the golden rule of current assets valuation and cost or market price, whichever is lower, originated from this concept. The realization concept also states that no change should be counted unless it has materialized. The conservatism concept puts a further break on it. It is not prudent to count unrealized gain, but it is desirable to guard against all possible losses. For this concept, there should be at least three qualitative characteristics of financial statements, namely prudence, that is, judgment about the possible future losses which are to be guarded, as well as gain which are uncertain. Neutrality, that is, unbiased outlook is required to identify and record such possible losses as well as to exclude uncertain gains. Faithful representation of alternative values. Many accounting authors, however, are of the view that conservatism essentially leads to understatement of income and wealth, and it should not be the basis for the preparation of financial statements.